In 1998, I was working for my dad. He has his own firm called FXC Investors Corp, where he was managing money at the time, and he also wrote a newsletter for over 25 years, right? I've said this numerous times. A lot of you know this. Now, my dad was the only person who called the 1987 market crash in writing. I mean, it's kind of like, once things happen, everybody says they call it. Kind of like the housing crisis. Like everybody, did you notice that everybody called it? Everybody called it. Now, everybody called it. After the fact, everybody called it. Yeah, right. But I published this newsletter and posted it on Twitter at Frank Curzio. You could see it. And I'm also bringing it up right now because it's relevant to my story here. And you could see it. And this is his newsletter. And I have you can follow us on Twitter if you want. I posted on Twitter as well, again, at Frank Curzio. But this is his October 1987 update, which came out September 25th. And it's titled Crash. And it says, we're now in a bear market. Dow above 2,700. It's at over 21 times earnings. Sound familiar? That's kind of where we are right now. Approximately 200% over book value. Talks about massive loans outstanding from the so-called LDCs, which is less developed countries, exceeding $400 billion. Remember when $400 billion was like a big number? That's like nothing now, right? It's like chump change. Talks about the huge federal budget deficit, things that we're going on seeing today. And he said 3 crashes occurred. I'm bringing this up now to show you guys. So here's the crash call. And this is his newsletter. And he goes on to say 3 crashes occurred in October. That was 1929, 1978, 1979. So we're going into October. He says this month's crash could be worse than the prior 3 crashes combined. He said that less than 3 weeks before the market crashed. And he goes on and talks about it. And this is cool. Again, it's nice to see these old newsletters, right? Because there was no internet back then. He says, since 90% of our research is based on fundamental, not technical analysis, we would defer purchasing most stocks at this time. Since 1929, stocks have never been fundamentally overvalued as now. And he goes on to say the entire free world's economic foundation is showing signs of cracking, an earthquake that may spread its fault from Los Angeles to Japan and Wall Street. He calls it the financial triangle. And then he has a little chart, which is really interesting, right? And he shows October 24th or October 29, 1929, how the market crashed 47%. October 29, this is to 932, right? So 29 to 32, also the market crashed 89%. And then he has a time date, 10/1/87, remember, it crashed like 3 weeks later, through and he's calling it for, the month through November that the market's going to crash. And he has question marks of how much is going to crash. So still one of the best newsletters. And of course, I'm biased here. But really one of the best newsletters, one of the best calls I've ever seen, because so many people say, they saw this coming, they saw that coming and everything. But, reality, when you have it in writing and, it was a big deal, right? It was a really big deal. Because back then, remember, no internet, no nothing. You had to go to the library to research reports. We had Quotrons back then. That was the technology that they used to get a couple quotes. And there was only a handful, in CBC when that started, that investors followed. It's not like it is today, right? So it was like Mario Gabelli, Abby Cohen, Louis Navalier, Jim Cramer, and, my dad was one of them, about, 10, 12 people. But today we have literally hundreds of analysts on TV just, shouting to the rooftops, most of them, promoting whatever they own. And again, back then, it's not like today where we have, egotistical idiots who don't give a shit about the small investor calling for a crash every year since the credit crisis in order to get more Twitter followers and sell more books. And then you know what happens, right? When the market pulls back 10%, they take a victory lap, even though the market's up like 250% from when they first had that call, which is, that's changing of the times, right? Nobody cares. Sorry about that mini rant. But going through that 1987 crash, my dad was prepared. He was hedged, short the market. Probably his biggest score in his career, because during those times, everyone was super bullish. And you have all these people leaning to one side, right? Side of the pendulum, where you're able to get in at an incredible price when that happens, right? You're able to buy stuff when nobody wants it, whether you're shorting it or going long. Good example, think Michael Burry, Mark Baum, right? Those guys made a fortune off the credit crisis, particularly the housing bubble. They did their research. They were able to short housing, and actually, it was so big, they created their own products. I don't know if you know that. I think that's, if you read the book. They created their own products through some of these investment firms so they could leverage their position and short the housing bubble. Hey, like Goldman Sachs always said, sure, you want to do this? No problem, right? So like housing never crashes and never ever crashes. But they did the homework and they knew. There's so much leverage in the market. But that's what happened when you make the most money. When you see a market or you're investing in a major event that nobody sees coming. Remember that point. I'm going to bring it back later. For example, you can make money on Tesla by buying it now, like Cathie Wood just did. She added to a position and Tesla came back a little bit. It's down 20%. But, she's not going to make a killing on that $170 million. Now, with Tesla at this price, could double. I don't know. Tesla could triple and quadruple the way that stock trades. But you get my drift where there's a pretty big difference where you're buying Tesla at $750, $800 compared to buying it at $40. And Cathie Wood's, ARK Investment, she was early to that investment. Barron, their fund, Barron's has been a huge supporter of that. Again, at 30s and 40s, amazing. But that's how you make the most money. Again, I'm going to bring back that point later on. But getting back to my dad. After the crash, he saw tons of people get wiped out. They were on margin. Old friends that lost contact with him suddenly were calling him, asking, what should we do? Because they got destroyed. They thought they were smarter than everybody. And living through that event, the emotions you see when something dramatic happens, it changes you forever. Think about it. Maybe you got into a car crash or a major skiing accident. I mean, next time you drive or ski, you're going to be super cautious because you're well aware of the consequences because you just lived through that, right? You lived through it personally. Now, fast forward to 1998. This is when I was working with my dad. This is the internet boom. Tech stocks were surging, and they were surging for a couple of years now. And I'm going to bring up a chart to show you this. Why I just shout numbers at you, but it's going to be very important. I promise you I'll make this interesting. So here's a NASDAQ chart going back to the 80s, but let's look at the 90s here. So when you look at the 90s, the NASDAQ from 1993, okay, say around 1200, 1993, 1200. Just put that 1,200 perspective. It's 13,000 today, pretty close to 13,000 today, right? Just put perspective. But it went from 1,200 to 3,000 by 1998. All right, so nice move here. 3,000, 1998, April 1998. That's 150% gain in 5 years, 30% annualized returns, which is incredible, right? Like over a 5-year period. And we didn't have a lot of exposure to technology. So for me, I'm like, hey, Dad, we need exposure to this, and just showing you this chart here where the NASDAQ was and how it surged and came back down. But when you see this event and you see what's going on, they've been taking off. They were absolutely taking off. So, and it's mostly technology, right? It's mostly the NASDAQ. And I'm looking at this going, hey, Dad, you know what? We really need to get into this. We have to get into this. And this internet thing is real. Let's get exposure to this sector as... we're seeing .com IPOs going up 100% in weeks. And nobody wants to hear about, hey, buy, hold, make 12% a year, which is an amazing return. Nobody wants to hear that, right? Just like they don't want to hear that in today's market. So we created a top 10 tech newsletter where I recommended 10 technology stocks. Well, I know my dad was just pretty much setting me up, right, to learn a valuable lesson. He's like, hey, you start it. See what happens. Now, a lot of people forget this, but from July to August of 98, the NASDAQ crashed. In 1998, it crashed. It fell more than 20%, 3,000 to below 2,400. And that 20% correction was like a month. It happened quick, and it turned out to be a head fake. So nobody really cares, so nobody talks about it. They just talk about this massive run-up. It was like, whoa, here it comes. This comes, and it didn't. It didn't really continue. Just it was a head fake. It only happened for a month. And I remember my dad saying, listen, be careful because this is not going to last forever. These returns have been doing this for decades. It's not going to last forever. So me at the time, being young, I'm like, you know what, Dad, you don't know what you're talking about. We need to buy more here on this pullback because I'm smarter than you. I know what I'm doing. Again, I'm smarter than my dad, being an analyst for a few years when he's been doing this for decades. Of course, that was my ego talking. From August 98, the NASDAQ started another major move higher. It surged to 3,500 by year end. That's the year end of 1998. Amazing gain. To 3,500 and then doubled again in 1999. And that was pretty much in 1999 through February 2000, which was a top. It went to 7,000 That's how high it rated. That's how extended it is. Lots of lessons to learn here. When you see bubbles usually go a lot further than people think, just like downturns. That pendulum usually swings well over before we see that adjustment. So a lot of people, a lot of good investors could be early to their calls. But 7,000 it went to. Of course, I'm sitting at the top of the world. I'm the genius. I'm amazing. Everyone was making money. And I'm young at the time. I'm supposed to feel that way. Just like young investors feel today. But it only lasted a little while. So NASDAQ peaked in March. It was 7,200. And then came the crash. Now, this crash wasn't like the recent ones we had from 2008 or last year, right? 2020, which some of you have lived through if you're a young investor. Because when you see those markets compared to, or those times compared to internet crash, when the market crashed after 2000, it was a 2.5-year crash where it fell tremendously. It felt like it was going down every single day. There was no, the Fed wasn't like, hey, this market's going down 25%, let's throw $1 trillion in. There was nothing of that. Like, no one ever thought of doing that back then. But it was long. It was painful. 2.5 years is a long time. I mean, nowadays with the internet and everything, TikTok, 30 seconds is a long time. I need it in 5 seconds, right? It's a different world. 2.5 years. The NASDAQ fell, eventually bottomed at 1,700. So the NASDAQ crashed. Keep in mind, this is a major index. We're not talking about a stock. This is a major index. Fell by 76%. Several of those top 10 technology stocks in my newsletter went under. Others went down 80, 90%. It was basically a complete wipeout. And for me, I had my tail between my legs. No idea what happened. I felt like a truck just ran over me. I'm like, what happened? I have no idea what happened. I lost my own money. And more importantly, my subscribers who followed me for that newsletter, I lost their money and I let them down. But there's several lessons to learn from this. And hopefully I could pound this into your brain. I'm going to try. It's probably not going to work, but I'm going to try. One is my dad was a pretty smart man. He knew I was going to fuck up. Sorry for cursing. But he let me make my own mistakes. He knew it was going to happen and said, the only way you're going to learn is if this happens to you personally. And that lesson, pretty much one of the most valuable in terms of my investing career. Because I learned about risk and how you have to control risk, why that's important. And of course, if you manage other people's money and leverage 30 to 1, you make as much money as you can, right? That's what so many hedge funds do, right? They leverage other people's money. But I'm talking about you, average investors. I mean, you have to limit your risk because once you lose that money, it's gone. You can't do it. You're gone. And the timing's terrible because the market's crashing and you want to have dry powder. It's the best time to buy stocks. But for me, it was a valuable lesson because I lived through it. My emotions were involved. I lost my own money. I let my customers down. And those emotions that you experience, I can't explain it. But it crushes you. Now, the past few years, we've seen the market surge. Of course, that was till March, right? When the pandemic hit, COVID. And then in recent months, a lot of young investors started getting into the markets. They downloaded Robinhood, the best app ever, easy to use, free trading. They changed the entire industry because everyone wanted free trading after that. They joined blogs like Reddit, WallStreetBets, where everyone's pumping ideas. Good for them. Many of those names they're pumping have gone up 2x, 3x, 5x, up tremendously. It's all fun. This trend sounds kind of familiar, right? A little bit familiar to the tech bubble. Because then we saw GameStop, AMC, United Airlines, heavily shorted names. We saw these names surge. I think GameStop hit 500 for a brief period, 500. It was trading in single digits like 4 or 5 months before that. And it went up so high, not because GameStop's a great company, but because it came one of the greatest short squeezes of all time. A stock where the percent that was short of the float was 140%. You don't have 100% of float. 140%, that's how leveraged they were. And almost put Melvin Capital out of business. Again, a hedge fund leveraging other people's money. And they got caught out there. Now to get bailed out for like $2.5 billion. It's always nice being a hedge fund. Yeah, some of these guys have some of their money in it, but all this money is someone else's. It's a lot easier to do that because if you're right, you're going to make a fortune. If not, hey, you're going to be able to start another fund next year and everyone's going to forget. That's Wall Street. It sucks. That's the way it is. But it's the truth. But over the past few weeks, what have we seen? GameStop go from $3.50 to under $50. AMC fall. Tesla fell by 20%. Tilray down 50% from its highs. And I know a lot of investors, even some emails that I've got, bought these names near their highs. That's the FOMO, fear of missing out. The problem is you fear missing out. The last people that get in get destroyed. And unfortunately, that's usually a lot of people. They just, programmed to think that these things are going to go up forever. They talk to their friends and they're like, oh, I made so much money on this. I made so much money on that. I made so much money on this. And they're like, damn, I got to get in this, man. These guys are making so much money. And they wind up getting wrong and they get crushed. They get destroyed. So a lot of these investors bought names near their highs. Again, thinking they'll go up forever. And you might be right. Like when it comes to Tesla, or some other electric vehicle stocks, or the streaming giants, Netflix, they continue to go higher and higher. But if you're looking at GameStop particularly, I hear a lot of young investors, and this is people who follow me on I have Frank Curzio Twitter or YouTube, and I see them on social media networks. I'm holding GameStop forever. I'm holding it forever. It's like a symbol that we could be just as powerful as Wall Street, even though they can't. And I know Melvin Capital is a good example, but you know how many hedge funds, which no one's talking about, shorted the shit out of GameStop at 300, 200, and 100 and made a fortune? A lot. You don't hear that story. It's not interesting. So when you just hear one fund, which $12.5 billion fund, Melvin Capital, gets nailed, that's really a very, very tiny amount considering it's $1 trillion industry. But yeah, it's a great story. Hey, we beat Wall Street. The young guys beat Wall Street. It's fantastic. But you have to be careful. Because when it comes to GameStop and saying you're going to hold it forever, and I don't care if I'm down, it's a terrible mindset considering the asset you own, GameStop, is basically worthless. Since its business model of selling video games through big box outlets is obsolete. Well, it's becoming obsolete. Many games can be downloaded straight from consoles. And for those who still feel the need to go into a store and buy a game, you have Walmart, Target in every single town. So unless they change their business model, get into whatever it is, that's different. But the current business model right now, the company's basically worthless. So you're holding on to a worthless asset just to prove a point. And that point's going to be is that you're going to get your ass handed to you from Wall Street and lose a lot of money. Because your ego's involved.